So the Ethereum network has recently gone through a fairly significant change called EIP 1559. EIP standing for Ethereum Improvement Proposal. And at the end of this year, it's going to go through an even more dramatic change called Eth 2.0, where it's going to move from proof of work to secure the network to proof of stake. So in this video, I'm going to unpack these changes, and I'm going to get into the impact that they might have on the price of ETH's token known as Ether. I first came across the thesis of these protocol changes having an impact on price a number of months ago, when I came across a report by an investor called Nikhil, who's also known as Squish Chaos on Twitter. And Nikhil believes that these two protocol changes could drive the price of Ether to as high of a number as $150,000 by January 2023. Since the release of his report, I see a growing buzz around the price potential for Ether in the short term. I can even see the likes of Raoul Pal calling Ether the greatest trade. Raoul believes the current setup for ETH is better than March 2020 was for Bitcoin, and as a result he's now overweight ETH in his portfolio. It's all very juicy stuff, so let's unpack it. I'll also link the report down below by Squish Chaos, so if you want you can check that out for yourself. So Ethereum is a layer 1 protocol that you can build applications on, and the network is absolutely flourishing with hundreds and hundreds of applications now built on top of Ethereum. The most well-known use cases are DeFi and NFTs. DeFi being short for decentralized finance and NFTs being short for non-fungible tokens. And I'm sure you're well familiar with both of these use cases at this stage. Ether itself is the token used to transact on the Ethereum protocol. So if you want to interact with a DeFi protocol, or if you want to mint an NFT, you need to use Ether in order to do this. Essentially, it's the currency for this flourishing network that's growing at an astounding pace. As I mentioned in the intro, there's two massive protocol changes underway for Ethereum, and they're expected to have a dramatic impact on the amount of ETH available to buy on exchanges. In his report, Nikhil suggests that this reduction could be as high as 90%. If this plays out and demand remains constant, then this is going to have a massive impact on the price of Ether. The real icing on the cake, however, comes if demand keeps growing at the pace it's been growing historically, and we see the supply reduction suspected by these two protocol changes. If this plays out, Nikhil has a price target in mind of $150,000 by January 2023. He's coined his theory the triple halving event, taking precedence, of course, from the halving event that Bitcoin goes through every 4 years, whereby the number of Bitcoins issued to the miners as part of the block reward for securing the network gets cut in half. And in the 2 years following the halving, Bitcoin has always seen its price grow significantly. This increase in price is generally contributed to the halving event and a reduction in supply. The author of this report has coined it the triple halving event because that 90% reduction he expects in Ether supply is the equivalent to 3 Bitcoin halving events. And to put a bit of context around this, Bitcoin has only ever had 3 halving events in its history. Firstly in 2012, then in 2016, and then in 2020. There are 3 main drivers for this liquidity reduction in Ether, and I'm going to take you through these in a second. But first I want to explain a metaphor to you, one that's quite commonly used in the Ethereum community to explain Ether the asset, and I think it's quite helpful. Think of Ether the asset much like water, and just like water, as Ether's temperature changes, so does its state. When Ether is frozen, it gets locked into position and it cannot be moved. It cannot be put on an exchange and it cannot be sold. And when Ether gets vaporized, it vanishes into the ether. It goes to an address that nobody has the keys to, and essentially it can never be moved, it can never be put on an exchange, and it can never be sold. Both of these two states remove liquidity from the market. In the case of frozen ETH, that liquidity is removed temporarily, and in the case of vapor ETH, it's gone forever. So now let's talk about the first driver of illiquidity for ETH, and that's the staking of ETH on the Beacon chain and in DeFi. The Beacon chain is a side chain of Ether, where people can stake their ETH in anticipation of the rollout of Eth 2 and proof of stake. These people don't get a return, they're simply locking up their Ether in support of the proof of stake transition. You can consider these people the really early adopters. Now at present there's almost 7 million Ether staked on the Beacon chain, which is roughly 6% of the total ETH supply. This Ether is locked in a smart contract and it cannot be moved until the introduction of Eth 2.0. However, when that happens, these stakers will enjoy a hefty yield on their staked Ether, so they'll be highly incentivized to leave it there. Why else would they be early adopters if they were simply going to pull it out before the yield was introduced? That doesn't make any sense. Now, staking is also happening on DeFi, where people stake their ETH into various DeFi applications in order to get a yield or in order to borrow money. When I last looked, there was roughly 10.8 million Ether staked in DeFi, or 9.1% of the total ETH supply. So if we sum up these two numbers, the 6% staked on the beacon chain and the 9% or so staked in DeFi, we see that 15% of the total supply of ETH is currently locked in smart contracts. However, I'm likely missing some data points, as ultrasound.money estimates a total of 24 million ETH is locked into smart contracts, or 20% of the overall circulating supply. This ETH ranges from cold to frozen and is largely illiquid. If we look at the total supply of ETH on exchanges, we can see it's gone from 26 million 12 months ago to just under 20 million today. And this of course makes sense considering more and more ETH is getting locked into smart contracts. Okay, so now let's talk about the second big driver of illiquidity, and that's the introduction of EIP 1559. So EIP 1559 was rolled out in July, and while there was many changes within this improvement proposal, the one we're most interested in is the changes to transaction fees. You see, previous to EIP 1559, all transaction fees paid on the Ethereum network went to the miners as compensation for securing the network. Now, in addition to this, the miners got the block rewards, which I'll get into in a few moments. But what's important to note is that since the introduction of EIP 1559, 70% of the transaction fees are now getting burnt. And this is the equivalent to the vapor analogy. They're getting burnt, they're turning into vapor, and they're gone forever. This change alone has reduced the inflation rate of ETH by about 30%, and is the equivalent to about half a Bitcoin halving in terms of supply reduction. Since the introduction of EIP 1559, there's been over 60,000 ETH vaporized. On an annualized basis, this is the equivalent to about 1.7 million ETH, or 1.5% deflation per year. Now, the final and most dramatic impetus for illiquidity happens when proof of stake gets rolled out at the end of this year. Well, at least that's what they're saying. When this happens, Ethereum will move off a proof of work system to a proof of stake system, and that essentially invalidates or negates the need to have miners. And as a result of that, the issuance that currently gets paid to the miners is going to be stopped. Instead, a percentage of this issuance is going to go to the proof of stake validators. But the other percentage of it is just not going to happen. Essentially, the issuance rate overall is going to be reduced dramatically. Now, with the current issuance level, the Ethereum network sees about 4.5% inflation per year. And after the change to proof of stake, this is expected to drop to below 1%. So a significant reduction. To make a good guess at the new issuance rate after proof of stake, we need to estimate how much ETH will get locked up in staking, as this will determine the required amount of issuance in order to secure the network. Now, you can see from this table that as the amount of ETH staked increases, so does the issuance rate. The yield to the validators also changes massively as an incentive mechanism to increase staking. At present, there's nearly 7 million ETH staked on the beacon chain, and that's with a 0% yield. Therefore, I think 15 to 20 million ETH is a very reasonable expectation once the yield incentive becomes available. And at this level, validators could expect a yield of between 4 and 5%, and we would see an inflation rate from issuance of less than 1%, roughly 80% of a reduction from today's issuance level. Now, in his report, Nickel estimates that number could be as high as 83%. And when you add the supply reduction from EIP 1559, that number goes as high as 90%. And that's equivalent to 3 Bitcoin halvings, hence the term the triple halving event. Okay, so now that you understand the 3 levers that are going to reduce the supply of Ether, let's talk about the price target. Nickel gives a base case of 30 to 50,000 US dollars. But he says if we see this massive illiquid frenzy, speculative frenzy, then that it could go as high as 150,000 US dollars. Only momentarily, of course, because this price isn't sustainable. Now, what gets us there is this massive speculative frenzy that comes from a reduction in supply which increases price, As price increases, more investors FOMO into the asset, which increases demand and drives price even further. And this vicious cycle continues until you get this massive blow off top that we've seen in crypto many times before. So what are my thoughts on this whole thesis? Well, I won't comment on the exact price target, but what I will say is there appears to be multiple mechanisms at play now and in the future that are going to reduce the supply of ETH available to buy on the market. One thing we can look at though is the historical rate of issuance for ETH, and we can plot it against the price of ETH over time. So here I have the price of ETH since 2015, and I've plotted over that the issuance rate. And what you can see is we've had two periods where the issuance rate dropped significantly. I'll highlight these with two yellow boxes. In the first instance, at the start of 2017, the issuance rate dropped by about 30%, and the price of Ether actually went from $45 up to $1,400 at the height of the 2017 peak. And this was an increase of 2,800%. The second time we saw a supply reduction was in 2019. And in this instance, the price of Ether went from 89 to 370, or a 300% increase in price. Now, this supply reduction wasn't to the same magnitude as the previous one, so you could argue that you wouldn't expect to see as high of a price gain anyway, and we were in the height of a bear market. But of course, these two price increases coinciding with the issuance rate could be just coincidence, but it is an interesting thing to note all the same. The other really interesting thing about ETH is just the level of developer activity that's happening on the network, and it far exceeds any other blockchain. So if we look at numbers released by a recent developer report, we can see that there's roughly 2,300 monthly active developers working on the Ethereum protocol, and this far exceeds any other protocol by an order of magnitude. And to me, this is a real leading indicator of success, because if we don't have developers building on the protocol, we're not going to have the future use cases, and we're not going to see a growing, flourishing network effect. So even if the protocol wasn't going through such massive changes to its tokenomics and issuance rate, you'd be very hard pushed to disregard Ether as a long-term investment. I think the risk reward is very attractive, but a thesis such as the triple halving event really puts the icing on the cake. Another thing we can do to put some context around the price target is if we look at the price appreciation of Ether over the past 6 years, and we can see that it's growing at a pace of about 160% compound annual growth rate. And if we extrapolate out this growth into the future, we can see it reaches $100,000 in 2025. Let's call this the fair value. However, if we had a deviation from fair value similar to what we had in 2017, then a number of $150,000 by January 2023 actually doesn't look as crazy as it would first appear. I have to say though, I do take issue with the Ethereum community calling ETH ultrasound money, because I think it glosses over the fundamental principles of what makes sound money, and that's the fact that it's immutable, it's unchangeable. You see, there's a reason the Bitcoin halving event is so special, and that's because you cannot change it. Every 4 years, the issuance rate gets cut in half, and there's nothing anybody can do about that. Nobody can make it bigger, nobody can make it smaller, and nobody can delay it. Just look at the Bitcoin issuance rate over time. It's like clockwork. Every 4 years, the halving happens. If we compare this to the issuance rate of Ether over time, you can see that it looks like a bit of a mess, and that's because it's changed so many times for multiple different reasons. So there's a big philosophical difference between these two protocols. They both have their use cases. Bitcoin is sound money, in my opinion, and Ethereum is something else. It's an application layer to build on top of. It's not sound money, at least not for now, in my opinion anyway. With all that being said, I'd love to get your thoughts on this investment thesis. What do you think of the triple halving event? Do you think there's value in it? And what do you think of Ethereum as a long-term investment? I'd love to get your opinion in the comments below. And thanks so much for watching this video. If you got value from it, please do smash the like button, and I'll see you in the next one.